It's time now for On the Radar, where we ask an investing professional what they're looking at in today's markets. We're back again with Lorne Steinberg. He's president of Lorne Steinberg Wealth Management. We're going to talk about something that investors should always have on their minds, Lorne, diversification.
Exactly, Paul. And diversification is a dirty word when one sector is going up. And for the last few years, it was all technology all the time. And so when we looked at our own portfolio, we had a number of stocks in the consumer and healthcare sectors that were doing absolutely nothing, therefore, massively underperforming the market, even though their earnings were going up, cash flow, dividends were rising. So we need to stick with those companies. Suddenly, in this market sell-off, when technology has basically led the sell-off, what are our best performing stocks? They're in the consumer staple sector and healthcare. And investors need to remember that you never know what the future holds. The reason you have a diversified portfolio is that sometimes one thing will do well, sometimes another thing will do well. Mm-hmm. And as long as your businesses are growing and doing what they're supposed to do, eventually that value will catch up.
What is the right number? I hear numbers between, like, say, 25 and 30. Is that the right number? And I think this has been studied extensively, has it not?
Probably. Now, for us, there's no right number, but too few is a bad thing, because if something goes wrong with a business, it's going to sink your portfolio. So, depending on where you're investing, anywhere from perhaps 20 stocks in Canada to 40 stocks and globally, whatever is a good number. But it's also the quality of the business that counts. So, having 25 small cap, oil and gas or mining stocks, that is not diversification. And so sector diversification does count. And like I said, suddenly we turn around and our best performing stocks have been all those boring businesses that have done nothing for the last few years.
And there's some that you can talk about. One of them is Kenvue in the U.S. It's the consumer products division of J&J. Right.
So J&J spun off this division a couple of years ago. This has all the iconic J&J brands, from Johnson's Baby, Tylenol, et cetera, Listerine. Kenvue is actually one of the fastest growing companies in the consumer products sector. It's giving you a 3.5% dividend yield. And now there's a big activist investor, Starboard, who sees the value. They've already taken a position in this company. They're trying to drive some changes there, probably sell off a couple of less, worse performing brands, et cetera. But the company is growing. This is a growth business. Good mid-single digit growth on the revenue side, healthy free cash flow growth, and margin expansion.
Another one that you've got is Kraft Heinz. This was infamous a few years ago for being a takeover that didn't work out very well. And in fact, the stock flatlined for a number of years, but it's showing signs of life now.
Sure, and this was part of this 3G group that came in and slashed cost, underinvested in the brands. They are now out of it. They have the company has reduced debt significantly, reinvesting in the brands, all of those great iconic brands. Who doesn't like, ketchup? But Kraft is selling at 11 times earnings with a 5.3% dividend yield, and it's returning to growth. And this company is once again, roaring back. And we look at Kraft Heinz as being a double-digit return for investors over the next few years.
And you invest in European stocks as well. You hold them on behalf of clients, and one that you hold is Nestle.
Nestle, believe it or not, the world's largest food company, is selling at roughly a 10-year low with a 3.5% dividend yield. Revenue stagnated over the last couple of years. They've changed CEOs. 25% of their business, Paul, is actually coffee. So they're the global distributor for Starbucks coffee. Outside Starbucks stores, of course, Nespresso and the famous Nescafe. And also pet foods, which is 20% of the business. We all know the growth in pet foods and people spending, tons of money on their pets if you have a dog or a cat. And so Nestle is returning to growth under a new management, new leadership. And when you can buy a great company at a 10-year low with a healthy dividend yield when everything has gone wrong, odds are pretty good they're going to turn it around.
And we talked about Kenvue, which was spun out of Johnson & Johnson in 2023. Briefly, you also hold J&J itself.
Sure. J&J, one of two AAA-rated credit-wise companies in the U.S., the other one being Microsoft. J&J, with the consumer products division gone, is now pharmaceuticals and medical devices, including hip and knee replacements. And J&J is trading at 15 times earnings with a 3% plus dividend. They are a growth business, expanding margins, great free cash flow. However, as we all know, the talcum powder issue remains the overhang. I've said this before, but this should finally get settled probably in the next quarter or two. They've already put aside a whole bunch of money for this, and so when this overhang is gone, the stock should do well.
It's Lorne Steinberg on diversification and 4 stocks.